This month, our chief equity strategist and economist, John Blank, looks at inventory shortages and how that impacts the U.S. economy. John, these shortages are present in pretty many industries. We've been seeing them for a while now, but are we at a crisis stage yet with this?
Well, we've been in this crisis for some time, Terry. I mean, the basic structure everybody's thinking that is completely absent of great insight for the most part is that everybody's thinking about we're in a cycle, like a cyclical pattern, of excess demand growth and excesses in the economy, versus what we are in is the aftermath of a supply shutdown caused by people trying to get away from a virus or prevent a virus. So the entire world economy, even today in parts of China, has been or will be or can be shut down. So suppliers were shut down, particularly factories were shut down. People had close working conditions. Offices were shut down. So in the aftermath of that, everybody stayed home and ordered online, and it created this, ascendance of the goods economy, created all the shipping shortages and huge inventory collapses in housing, in autos, and really across the entire spectrum of retail. Obviously today we're getting Walmart reports, of the excesses, but that's part of it is because they have the wrong kind of inventory as people shovel out of this thing and into the next thing. But the overall inventory to sales ratios, which is a studyable thing, is 20 to 30% lower across all these on average. And so and that, of course, Terry, if I just tell you there's a shortage of inventory and goods, what would you expect prices to do?
Normally go up.
Go up. And so we have a high inflation rate, about 5 or 6% outside of food and energy, 8 or 9% with it. And this is exactly what you would expect after a supply shock, that the inventories are low and the prices are high because of the lack of supply because you shut it down. So my point here is these inventory things. Today we got one today that said, minus 0.9 on the GDP for Q2 and 2% of that 0.9. We had a 1.1 final domestic sales growth, but we layered on 2% of inventory adjustments. And this is what I'm talking about before this came out. These inventory adjustments are not throwaways. They used to be in a zero, just in time, very stable 2% growth rate economies. It used to be that way. It's not that way. And that's what everybody's got to get their arms around.
So this picture gets a little complicated here for a lot of people to understand. Is the COVID shutdowns the main contributor to these inventory shortages, or are there different causes for each industry impacted?
Well, it's both, Terry. The broad hit of COVID was clearly, the major case. But then you add in, things like the Fed mortgage-backed bond buying that happened at the same time. So they lowered mortgage-backed interest rates at the same time everybody's locked into their houses, which was maybe the worst match of a policy response to a situation that I know of. But now, again, you say, did that cause a lot of damage or not? Well, people were locked in their houses. Inventories fell because you couldn't sell your house or couldn't move. And then housing inventories have gone way, way down. And by the way, prices were way, way up. So same thing happened with autos. There was a mixture in with the chip shortage because everybody bought computers. And so the chips demand went up. And then people who wanted chips in autos, which are now very automated and have chip demand that's very high, they went up and everybody got more shortages there. So, and then you get across retail and all that stuff. Some of it's excesses, some of it's surpluses, some of it's too little demand. Everything's gotten mixed up because of this response over time. So the basic point is, yes, it was COVID, and no, you can't generalize. If you read my inventory report from a month ago, I borrowed, from cars.com. I borrowed from Shopify. I borrowed from the NEA of realtors because every single economist in these sectors has 5 or 6 things they're looking at that are very specific to the situation that is playing out in all of these various groups.
Yeah, and then there were errors in inventory data and unreliable forecasting, right?
Right. Just for example, I tried before this show to go, I looked up inventory accounting, Terry. As it's production equals consumption minus closing plus closing inventories minus opening inventories. Mm-hmm. That's the equation. Now, there's some viewers out there. Okay, there's 3 factors: the amount of consuming sales that goes on, the amount of closing inventories, meaning how much you have at the end of the cycle of the quarter versus the amount you have at the beginning. So then all of a sudden you get prices for the opening inventory, prices of the closing inventory, so they're 3 months apart. Then you've got to figure out what are you going to call inventory for all these different groups. And then you've got to figure out how to match that with sales and get the number right. And then you got to figure out, like we did here, a minus 2%, is that positive or negative? Terry, what that means is opening inventories were much higher than closing inventories, which means people didn't actually stock. So is that because they couldn't get it through the ports? Or was it because everybody's so worried about a recession, they're not buying inventory? Who knows? And again, it's probably all of the above. And this is the multiplicity of this whole scenario is confusing a lot of people, and it is very confusing.
Yeah, that's what complicates it, no doubt. So do you expect this inventory situation to continue through the duration of what's going on with the economy right now?
I do, Terry. I think this is what I'm trying to point out to people, that in the aftermath of a supply shock, we all need to become much more cognizant of the upscaling of inventories and houses, being more sales signs in your neighborhoods, the amount of cars on car sales lots, the amount of goods that are being marked down and sold in various areas of your communities, whether it's retail or online. All of this has to surge up before we get prices under control, because it's choice of inventories, the amount of inventories that will be the first stage of that whole process.
And speaking of the current economic situation, you've written that current Wall Street recession fears are being stoked by patchy U.S. economic data. What does that mean? Is the data somehow questionable?
Well, this is what we're talking about, Terry. I mean, we've had minus 1.6 GDP growth in first quarter, minus 0.9 in the second. And just for example, Terry, just to understand what you got to do, you got to go to the BEA account, and then you've got to click on related materials, not the news release, right? So you got to be a real economist. Go to the reader mirrors, and you got to click full release and tables, and you got to click on that. It's a PDF, and it'll have to take me a few seconds to load it here. Yeah. And then I've got to go down to this, and then I've got to go all the way back on this PDF to the seventh page of a PDF that I clicked through twice to get to this, right?
Okay.
And then I get to non-residential fixed investment structures, and I see, minus numbers starting in the fourth quarter of 2019, but there's minus 47% in the Q2 period, minus 15 in Q3, minus 8, then it was 5, then minus 3, minus 4, minus 8, minus 1, minus 12. So 11 quarters, there's only been one positive structures investment playing out for 12 quarters. So why didn't we know about this? So you say, well, that's 7/10 of that 9/10 reduction is this structures decline of 11.9%. That nets out to a 7 of the 9% of 70% of it. You say, what is that, John? I mean, it's not something that happened in the second quarter, Terry. It's been on for 11 quarters. And what is it? It's you and me sitting at home, not going to the office. There's 25% office occupancy vacancy rates on average across the country. So who on earth is going to buy office investment? Unless it's a specialized situation like Google and the Thompson Center downtown in Chicago, it's basically sitting empty.
So against this background, and looking at GDP data for the recent past and the present, as you've alluded to, are we in a recession yet?
The answer is no, Terry. We're not in a recession. We are in a structural change that is playing out over time in a manner that's confusing people. And my language probably won't help, but that's the basic problem here is it's not a cycle, it's a structural change. We had a shock, and this is a change, and everybody has yet to appraise it because the GDP accounts are basically from the 1930s, not the 2020s. And if I just want to get to that whole idea, Terry, I want to show you for myself as an economist when GDP accounting started. It was 1937. It was a guy named Simon Kuznets, who was an economist at the National Bureau of Economic Research. And his idea was put up in, quote, national income, 1929 to 35. So back in those 6 years, basically that was the Great Depression. The worry was stimulating aggregate demand, and they put together GDP accounting. GDP was an idea that came out of that 1937 paper. He won the Nobel Prize in 1971 for it. But this is the problem. GDP accounting was for stimulating aggregate demand out of recession. It has some resonance, but it is not accurate in an insightful and the way we need it to be during a supply shock when a COVID pandemic happens. Since the last virus pandemic, the Spanish flu was, 1919, which was 20 full years before Simon Kazak even addressed this.
Yeah, but that's what is complicating for a lot of people. They're going by the definition of 2 consecutive quarters of negative growth constitute a recession.
Yeah, and basically that there's nothing wrong with simplifying until you realize, what you're looking at is not that simple.
Yeah, and then you add on to that another rate hike that we saw by the Fed this week. So the question now in everybody's mind is, are these rate hikes working? What do you say?
Well, basically, again, we're back at the Fed funds rate of 2.5%, Terry. This is basically a level that we had in 2019 before the COVID pandemic. People forget we had a 3.6% unemployment rate in 2019, and we have one now. So, in fact, the Fed funds rate is just getting back to a normalization. We have yet to see restrictive policy, and that's what's very lost upon a lot of people.
So if we saw that, then what?
Well, then what we'll find out. But today, 12 basis points fell off the 10-year Treasury rate because people are arguing that this may be where, the Fed stays long-term for quite some time while this supply shock effect peters itself out in multiple ways across time. And people are really struggling hard to read in to the Fed statements month on month. They're like, there's a lot going on here. It's like, yeah, and so you shouldn't read as much into it. Powell is now back to where he wants to be at 2.5. He's no longer behind the curve, and he's going to sit in his job and really pay attention to the data from now on out. And there really is no template at this point. They really do want to be flexible. You should let them be flexible. It would be how you would do this job if you're dealing with an unprecedented situation that you have no real visibility on. And that's basically, saying, hey, it's a government official, I don't know what he's doing. Forget it, man. Unless you can say how you personally would do it better, other than going to meetings and being religiously dependent on learning as much as you can, unless you can improve upon that, you should basically understand he's doing as best a job he can.
All right. While we're waiting to see how this all plays out, a few large cap stocks on your radar include Bayer AG, CrowdStrike, and Ulta Beauty.
Yeah, let's talk Bayer AG. This is a value of $14 a share. It's a drug stock. You got a nice entry point. Even back in June, it was $17.50 a share. So if you're going to look for a play in a German stock because of the whole disaster that's happening over there, nice time to pick up Bayer. CrowdStrike. This is a 2-rated stock with an A for growth. It's $180 a share, but it's got a much more palatable chart for the trader. CrowdStrike is in this next generation threat prevention and intelligence and cyber attack space that people love. So you got to like CrowdStrike. Take a look at it. And then Ulta Beauty. This is, a story stock in the cosmetic space, a number 2 rated stock, A for growth. Shares obviously really pricey at $400. I don't see a lot of upside in this one, but you got to know about the name. This is a really popular Chicago-based, actually suburban Chicago-based fragments and cosmetics company. Great stock to know about.
All right, our chief equity strategist and economist, John Blank, clarifying a lot of the complexities of the current economic picture. With John, I'm Terry Ruffalo.
This material is being provided for informational purposes only, and nothing herein constitutes investment, legal, accounting, or tax advice, or a recommendation to buy, sell, or hold a security. Do not act or rely upon the information and advice given in this podcast without seeking the services of competent and professional legal, tax, or accounting counsel. Publication and distribution of this podcast is not intended to create, and the information contained herein does not constitute an attorney-client relationship. No recommendation or advice is being given as to whether any investment or strategy is suitable for a particular investor. It should not be assumed that any investments in securities, companies, sectors, or markets identified and described were or will be profitable. All information is current as of the date herein and is subject to change without notice. Any views or opinions expressed may not reflect those of Zacks Investment Research as a whole.